Well, hello. Hi, traders from all over the world. Welcome. As mentioned, my name is Oliver Velez, and I'm coming to you from what is now beautiful, sunny Wellington, Florida. And I hope this speech today, I hope my talk today finds you all doing as well as you possibly can. I hope you're all safe and healthy, and I hope the vast majority of you are still home. But listen, I have exactly 30 minutes today to try my very best to rock your world. We're going to talk about the markets. We're going to talk about specific tactics and techniques that I believe will give you an edge in your trading and in your investing in what I'm going to call presumptuously a post-COVID-19 world. Now, I have to get certain things out of the way first. So number one, I actually want to really give a very special thank you to the International Money Show and the organizers, the individuals there whom I've known for decades now. I'd like to thank them for inviting me once again. This will be my third time as one of the keynote speakers to this grand international event. You see, this event started all the way back in the late 1990s as the International Day Traders Expo. And the industry at that time, the very first year, we all grouped together as a worldwide industry. The industry saw fit to select me as being one of the key spokesmen for the entire industry, and I became the first inaugural keynote speaker to the first event. That was followed up actually by the second time I was given that honor the very next year in the year 2000. And this makes the third time that I'm being invited to do this. And I want to give a very big thank you to the organizers for doing that. It is an honor that I do not take lightly, and it is an honor that I greatly appreciate. So the second thing I want to do is get out of the way. There are many of you, thousands of you who have come into this industry over the years, if not millions of you who've come into this industry over the last 3 years, over the last 10 years, over the last 20 years. And many of the newer individuals coming into this industry are likely not to know exactly who I am. So give me a few minutes to introduce myself, to give you a little background about my history in this industry and why organizations like the International Money Show do invite me to speak. So without being said, let's do that. Now, I have been in this industry for the last 38 years, actually. I placed my first trade in 1981. I became a professional trader on Wall Street in the year 1986, December 5th of 1986. I worked on Wall Street for a number of years, and I actually did extraordinarily well, setting a number of very important records. In the year 1994, I decided to go out on my own, and I started a company called Pristine Capital Management. Now, a lot of you or some of you might know this organization because the organization I formed in 1994 called Pristine, commonly referred to later as Pristine.com, became one of the largest trading organizations in the world. We had literally millions of followers and thousands upon thousands of traders spread all over the world. And we became known as the or one of the most premier organizations to go to for training and education as far as professional trading is concerned. During that time, actually, I also formed what was commonly referred to back then as a direct access trading firm. This is a firm that was not necessarily purely a retail trading firm or brokerage firm, but a firm that specifically focused on active day traders at the time. And this firm was one of the first firms to give direct access, professional traders direct access to the markets without any middlemen, without any intermediaries. And that firm became the second largest direct access brokerage firm in the United States. And this is going all the way back to the mid-1990s. Well, my popularity in the industry, some of the things that I've accomplished in the industry led to Barron's ranking my organization and my work as being number one in the educational field for professional traders. Dow Jones called me the messiah of day trading at the time. And in 1999, as I mentioned earlier, the organization that was at that time called the International Day Traders Exposition or Expo selected me to be, getting a message here that my internet connection is unstable here. Let's hope that that does not continue. Selected me to be the first inaugural keynote speaker. Today, traders, I'm still one of the most sought after speakers in this space, in this industry. I speak all over the world. I continue to be advisors to major organizations and institutional trading firms throughout the world. I also have advised various stock exchanges on the subject of volume and active trading throughout the world. Today, I also continue to run one of the largest trading organizations in the world. We are more than 10,000 traders strong. I have traders in over 43 different countries, and I've spent the last several years focusing on Brazil and other parts of Latin America to recruit traders, to recruit traders to this incredible space called active trading. So that is basically, in a nutshell, who I am. I've been around for a very long time. My professional career has spanned 3 decades now, 33 years to be exact. I'm considered to be one of the go-to individuals in this industry as far as teaching, training, and trading. So with who I am out of the way, and my big thank you to the organization out of the way, I want to actually talk to you about certain things that I believe will give you deep insight into where we are in the markets today. What has happened to the market today. And when I talk about market, I am talking about an overall broad market. Whether you trade options, bonds, futures, stocks, cryptocurrencies, it really doesn't matter. What I'm talking about is universal across all markets, what we'll talk about today. And what I want to leave you with before my complete 30 minutes is over with is a clear insight of where we are, where I think we're going, what I think the world will look like after the COVID-19 pandemic that we find ourselves in. And I want to leave you with some concepts, with some specific tactics and techniques that I truly believe that will serve you extraordinarily well. If they served you well before, I believe that they actually are more valuable in a post-pandemic environment. And so I did not just want my keynote talk today to just be very general about the markets and what my projections were. I have been known to have extraordinarily accurate projections, but that's not really what I wanted to focus on. I wanted to do something a little bit more than give you a broad talk today. I want to leave you with something that I believe that you can utilize for the rest of your trading and investing life. Now, the concepts that we will cover are simple, but they're very powerful. They're simple, but not necessarily easy to deploy, okay? But I want at least to accomplish you understanding the concepts. Now, let's get to the first one. The vast majority of my focus today with you is going to be on a concept that I call space and distance, okay? Space forms one of the cornerstones of my method, and I've taught more traders in this industry than virtually every other organization in the industry combined over the past 25 years. At the foundational level of my method is this concept called space. Now, what we're going to need for me to talk to you about this, to explain this in great detail, is we're going to need a chart, okay? We're going to need a chart any time frame. So whether you are a micro trader and you use a 2-minute chart, or whether you are a swing trader and use a daily chart, or you're an investor that uses monthly or weekly charts, we're going to look at the market through the eyes of charts, but understand that what the concept that I'm explaining to you is universal across all time frames and across all markets. It does not matter what you trade. This is applicable in cryptocurrencies, equities, futures, Forex. It does not matter, and the time frame does not matter either. And I will demonstrate that to you before my time is up. We're going to need a simple 20-period moving average. We're going to need a simple 200-period moving average. Now, in all of my years of study, I get this as a very frequently asked question. In all of my years of study, I've never found any direct evidence that the sexier varieties of moving averages are any more superior than the simple. So I keep all of my moving averages simple. Can you use exponential weighted triangular? I think the differences are not great enough to really make a difference. So if you happen to be married to or tied to one of the sexier varieties, then by all means use it. Moving averages are not glass floors or ceilings that break or shatter at the first point of contact anyway. They're more like fences that you can lean on. Moving averages are more like trampolines that you can bounce up on. They have some give. They have some leeway. They're not these skinny lines that your trading platform might have you believe anyway. So simple is the way I go, but if you're tied to other ones, you can certainly use those. And then I need you to understand this single and dual space concept of mine. So these are the four things we need: chart, 20, 200, single and dual space concept. Let's go. Now, here's a 2-minute chart of the Dow Jones Industrial Average. Okay, it's not today. I just used a recent chart, but it's not a 2-minute chart of the Dow today. I did not have time to do that, unfortunately. But of course, as you can see, every bar represents 2 minutes of trading. This could be a daily chart, a monthly chart, a weekly chart, doesn't matter, like I mentioned to you. Now, of course, the green bars represent the 2-minute periods in which the Dow rose from low to high. Now, if you look very carefully, you have the red bars as well, which represent 2-minute periods where the Dow Jones Industrial Average actually fell from high to low. All right, as we can see, the Dow Jones Industrial Average during this period of time that we're looking at was largely in an uptrend. And in an uptrend, if we count the bars, we would have literally just glance at the number of bars that are green versus the number of bars that are red. We can see that the footprints of the green team are largely outpacing or outnumbering the footprints of the reds, right? In addition to that, on average, except at the end, the size of your green footprint seemed to be heavier on average than the size of the red footprints. Now, this is a very important concept. We won't spend a lot of time with that, but just a simple count of which team is producing greater footprints and much larger footprints than the other can give you a very, very powerful edge in your trading. And so you should be able to take a look at any chart, any time frame, any market, and basically at the blink of an eye, say, look, the green team is dominant. They have far more footprints than the red, and the size of those footprints on average are heavier, bigger, taller than the red footprints. Okay, there's your 2-minute chart. Now we need a 20-period simple moving average and a 200-period simple moving average. We use these as a buddy system. And I believe that whenever you're using a buddy system like moving average approach to the markets, where you're using 2 or 3, but preferably 2 moving averages, you always need a shorter one versus a long-term one. And I see this mistake a lot of times in the technical world of trading, where a trader will have 2 moving averages that are too close in nature to each other. And one is actually sort of canceling out the importance of the other. The power is in the contrast between the short-term trend of market movements and the longer-term trend of market movements. And we need to see this short-term movement versus the longer-term movement in relationship to each other. Okay, so 20 and 200. Now I'm going to superimpose the 20-period simple moving average and the 200 on this Dow chart, this 2-minute chart of the Dow Jones Industrial Average. Now, there are a few things that are very important for me to point out to you here. I'm going to grab my annotation tools, okay? I want you to note that for the vast majority of the Dow's chart here, you'll see that the Dow Jones Industrial Average, it comes relatively close to the 20-period moving average, even sometimes below, and then it rises above. Then it comes back toward the 20-period moving average, then rises above again. Then comes back toward the 20, and then rises above and comes back toward the 20 again. Now, this repetitive cycle is the only thing that the market really can do. There is only one cycle that all markets repeat over and over again. It is this cycle. Let me draw it to you. Let me draw it for you separately. This is the cycle. And then the market just simply repeats itself. Now, what makes it a tiny bit confusing is that this cycle sometimes is slanted upward like this. So the left leg is not as the same size as the right leg. And that's what we see in the Dow here, where the right legs are shorter than the left legs. You see, the right legs tend to be shorter than the left legs. That's the cycle when you have an uptrend. The left leg is the long leg. The right leg is the short leg. Okay. So sometimes also the cycle is like this. Well, let me draw that a little bit better, like that. So in this case, the left leg is the shorter one and the right leg is the long one. And that's the cycle that you get in a downtrend. So in reality, if I can erase these, let me see. When I do that, clear all. So you have this repetitive cycle happens in 3 different formats: sideways, up, up, and then down. 1, 2, 3. And if you understand this concept, you will automatically, quite dramatically, increase your timing with entries and exits, because this is the perfect segue into the next thing I'm going to share with you. You see, markets can get, we're going to focus on the 20-period moving average here. Markets can get away from the 20-period moving average. They just can't stay away. So I want you to think of an accordion. The markets can get away from the 20-period moving average. They can't stay away from the 20-period moving average. The accordion can stretch out, but after stretching out, the next movement is in. It's almost like lungs or breathing. The market is a breathing mechanism. It exhales and inhales. The exhale moves away and the inhale moves back. The exhale moves away, the inhale moves back. The exhale moves away, the inhale moves back. So the first thing you should be doing when you're looking at any market is, what part of this cycle am I in? Am I in the lower left-hand part of the cycle? Have we moved away from the 20? So am I sort of near the top of the cycle? Are we declining from the top of the cycle? And have we come back to meet or slightly dip below the 20-period moving average, which would now make us on the right-hand side of the cycle? Now, there are millions of people who step foot into the market without knowing these basic but powerful concepts. And these individuals are the ones that make some of the biggest mistakes of selling at the wrong time here in the cycle and buying at the wrong time there in the cycle. Now, what's really interesting about this, traders, is that from a human being point of view who's been socialized in, theoretically, a civilized world, we are conditioned to be terrible market participants because we are taught certain things that force us or that train us or condition us to want to go into the market after proof. So we want things to prove it to me and then I'll do it. Give me some proof. Show me. This is part of our social conditioning, which makes us terrible market players, because the very best time to come into the market is when the market is not proving anything to you. In fact, it's showing you the opposite of what you really desire. So look at the movements away. This is the proof that your social conditioning wants you to have first. Show me first that you are strong, and then I will buy. Wrong. Show me first that you are worthy of my money, and then I will buy. Wrong. Show me first that you are good, that you are strong, that you are behaving. Show me this first, and then I will buy. Wrong. When in fact, the proper approach is, show me after you have been strong that you are taking a rest. That's when I want you. Show me after you are strong that you are now taking a rest. That's when I want you. Okay. So the next thing I want to point out to you, the next thing I want to show to you is I want you to measure the space between the tops of the market and the 20-period moving average. Now let's do this. Measure the space, the top and the 20. Measure the space, the top and the 20. Now, they're never going to be equal or the same, but you'll be quite surprised that many are relatively similar. So the spaces start to create a cycle that is repetitive in size and depth. And this happens on both sides of the 20-period moving average. So that you can literally measure when the Dow has moved a certain deviation away from the 20, it's overbought and buying is off limits until you come back toward that 20-period moving average. Now, some of you might be asking, well, Oliver, okay, I understand we don't buy away from the 20, yes, but we buy near the 20, yes, if the 20 is rising. You see, the 20 is rising. Okay, so yes, we don't buy away, we buy near. But when do I strike? Simple. We play the color game. When green takes out a red. See that point? Green has traded above red. Green has traded above red. Okay? Whenever green trades above red near the 20, it's a go. It's a very, very simple but powerful concept. But the space element is what I want you to think about. So now, I told you initially that there's a single space concept I want to show you today and a dual space concept. The single space concept is the stock and the 20. That's single. This is single space. You see? Single space. The stock and the 20, single space. But there's a dual concept as well we have to bring into play. And that is when you have the 20 separated from the 200. So now we have dual levels of space. We have not only a separation between the stock and the 20-period moving average, but we have a separation between the 20-period moving average and the 20 and the 200. So there's like this 3-finger spread. The stock is at the top, the 20 is in the middle, the 200 is at the bottom. And when you have the 3-finger spread, the declines will start to become more violent, more severe. These are not going to be on average resting declines. You see, the declines prior were sort of just resting. All right, it's a little overbought. Let's rest and get back to the winning side. Let's rest and get back to the winning side. But now we have the dual layers of space developing, whereas that here you had less of it. You had small, but when they get really wide apart, watch out below, okay? Now, let's keep going forward here. Let's keep going forward here. How do we get out of this thing here? All right, boom. All right, here we have a 2-minute chart of Facebook. It's not today. Unfortunately, I did not have time to grab the charts today. But again, 2-minute chart, doesn't matter, whatever your time frame. Let's throw the 2 moving averages on. Now, I just wanted to show you an example of one moving to the downside as well. So notice that the 20-period moving average is declining. That declining 20-period moving average is under the 200. And at certain moments, we've got the dual layers of space. So we already know that when a stock can get away from the 20, it can't stay away from it. It can stretch the rubber band away, but it can't stay away. You see, we can get away, but we can't stay away. It has to come back to the 20. It's almost like the 20-period moving average is the leash, the stock is the dog, and the dog runs a little bit too far, and then the leash pulls the dog back in. You understand? So if you are playing Facebook to the downside, which you should be because you should be trading in the direction of the 20-period moving average. When the 20-period moving average points upward, you should be looking to buy at or near the 20. When the 20-period moving average is declining, you should be looking to bet down or short near the declining 20. But you should not be doing this away from the 20. So it's not a time to go short here. It's a time to go short there. We've come back near the 20. You understand? We can go short here near the 20, or when this red eliminates green, okay? Or let's erase this again. This red, right? This red eliminates the low of that green. Boom, okay? Now we come back toward the 20. Look at this green gets eliminated by that red. I tell my traders to come from all the way out here. Boom, short. This red eliminates this green not too far from the 20, all right? Boom. This red eliminates green not too far away from the 20. Boom. So if your entries are near the 20, then your exits should be away from the 20. Why? Because stocks can get away. They can't stay away from the 20, right? So check this out. I'm gonna keep track of my time. I got five more minutes here. I've got a lot more to share with you over the next 2 days, so I hope you join me. Okay? So we want to take profits away and get back in near. Take profits away, get back in near. Take profits away, okay? Get back in near. Now, when do you stop the game? When you start to get dual layers of separation. So a trader might say, well, Oliver, why did this move back up? Well, look at your separation. The game is over. The best part of the game is when there's not that much space. The game is over when there is a lot of space. Then you start to get a breakdown in the consistency of this method, right? So look how wide the 20 is with the 200. And if you go over here, you have wide from the 20 to the 200, it's wide. And from the low of the stock to the 20 is wide. You get that 3-finger spread. Now, this is exactly the concept I used when I called on point at the last Money Show in Orlando on February 7th. I called for one of the biggest, sharpest market declines in history, and we got it, but it wasn't rocket science. With this concept I'm sharing with you today, you could have done the same thing. Let's go to that really fast if I can. I hope I have time to do this. Let's do this. Let's do it. Shall we? Let's do it. Boom. Let's see if I can get out of this, and let's see. I want to make sure you can see the whole screen. So if I were to go, guys, if I were to do this, right? Let's say, let's take a look at AMD on the daily chart, right? This is a stock called AMD, right? I mean, look at what I'm sharing with you. You should now be able to take this stock and know precisely that we're narrow here, but we get away and then we pull back. All right? We get away and we pull back. We get really sharply away, and look at your dual layers of space between all three. And this is where the biggest, sharpest decline in many years occurred, when you have the 3-finger spread. Now look at where we're going back. We're going back now off the lows, back to this wide, 3-finger wide separation potentially. Okay? So remember, I always want you to remember, stocks can get away. They can't stay away. They can get away. You know, away. They can't stay away. All right, it's very simple. We can go all the way back to, we can look at the Dow. Why didn't I erase this stuff here? Clear all. And we can take a look at a bigger time frame if you like. And we can look at the big giant collapse that we had, right? Take a look. So notice how when we get away, you've got to rest a little bit somewhere. You get away, look, the 3-finger spread, boom, boom, wow. This concept of single space, Now, what's single space? Stock away from the 20. That alone can actually help you with your timing. You never jump into the markets away. You're always looking to get in near the 20. You're always looking to trade in the direction of the 20, the flow of the 20. No fancy stuff trying to go against that, at least not now until the next couple of talks I have this week with you. I'll teach you the exceptions. But you trade with the 20 and you use this away near concept, color change near in, away out, color change near the 20 in, away out. Now, if you take this concept, that's the single concept, and you add the dual concept, this is when you'll start to know when the major turns happen, because the single space concepts are just when to take short-term profits off of the table. But when you start to get the three-finger spread, when you go from single space to dual space wideness, this is what tends to lead to major market or stock turns. And so I never want you ever again caught here. Let me show you. I never want this to be you. See the top of that? I never want this to be you. Someone is holding the very top of the market there because they did not know the space concept. I never want that you. I want you selling to this individual, all right? And look at the space now beneath the 20. We can get below the 20-period moving average. We just can't stay below the 20-period moving average. There you are, traders. The space concept, any time frame, any market, and I guarantee you, if you apply the single space and the dual space concept, that you will rarely find yourself on the wrong side of the market. Welcome to the professionals circle. Ciao for now. Guys, I just want to let you know that I will be speaking once again. Let me just do this for you if I can. Let me show you my talks for tomorrow. All right, I don't want you to miss that. Okay, I will get to it here. Boom. So tomorrow at 3:30 to 4, I'll be talking to you about the 5 sectors to focus on right now. I want you to be in the right spot. I want you to have this concept of single space and dual space. Now let's take this concept and let's go to the right spots with it. Let's go to the right group of stocks. Let's go to the right pockets of the right market. And let's take this concept and turn it into something, turn it into gains, turn it into money, turn it into our future. Okay, I'll also be speaking to you on, I didn't put the dates there. This is Wednesday. I believe it's at 2 o'clock, 2 to 2:30. Yes, that's right. I just have it separated. So why traders today? I'm going to talk to you about why traders are outperforming long-term traders. And I'm going to teach you, if you happen to be a long-term trader who's only married to the long-term, I'd like to try to convince you to incorporate just a little bit of short-term stuff in your long-term play. And if you're just a short-term trader, I've got to bring you a little bit to the other side, incorporate the long side. These are not choices. This is like sort of separating the heads from a tail in a coin. And I can't have you do that. So I will see you tomorrow at 3:30, and I will see you Wednesday at 2 o'clock. Ciao for now. Enjoy the rest of your evening. Enjoy the rest of your morning, afternoon, depending upon where you are in the world. And I hope I've done my very best to blow your mind just a little bit. Ciao for now.
Thanks, Oliver. We really appreciate your time. And thank you all for joining us today. We kick off tomorrow morning at 10:50 a.m. Have a great night.
Ciao.